Literally, 2 years ago, Palantir was trading under $10, and now it's up over 1,000%. And everyone wants to find that next best stock that's under $10. That's why the most common question that I get from viewers is, which stock is going to be the next Palantir? Now, keep in mind that Palantir is not a new company. They've been around for over 22 years, and they went public in 2020. Palantir stock rose right after it launched, and then they fell down to its lowest point around December of 2022. And guess what happened about that same time? Yeah, that's when ChatGPT was launched and it began a major AI race. And ever since that point, Palantir stock has done nothing but blow up. My point is that Palantir was always a great company, but the release of ChatGPT was the catalyst that really helped make Palantir so popular. The next top company is probably already out there, but it's just misunderstood and it just needs a little more visibility. So I had researched a ton of articles and analyst takes on the top companies that are under $10. And that's exactly what we're going to review today. And then at the end of the video, I'll give my take on the top 3. But before I jump in, if you feel that I've earned a like and a subscribe, please take a second to do that so my channel can continue to grow. Let's jump right in with Creative Realities, which is the behind-the-scenes partner powering those slick digital menu boards, in-store video walls, and stadium signage that you see everywhere. Unlike a basic screen seller, they bundle hardware, cloud content management, and the creative service into one plug-and-play package. Their Clarity software lets big brands swap messaging in seconds. Literally, there is no IT ticket required. In their latest quarter, revenue did dip 21% as a handful of major rollouts had shifted into future periods. And gross profit fell roughly 22%, which is in line with the revenue. But margin did hold steady at around 46%, proving that their service-heavy mix still commands decent pricing. Importantly, they shaved down debt to assets from about 47% to 42% by paying off roughly $2 million in debt. And this is just proof that they're using cash flow to strengthen the balance sheet and not just fund new installs. Analysts have their 12-month forecast up 207%. Wow, that's a pretty good start to the video. Now I'll move on to Array Technologies that makes the motorized racks that tilt solar panels to track the sun all day, boosting the output by up to 25% versus a fixed mount. They've built one of the only US sourced supply chains for utility scale trackers, which means projects qualify for government tax credits and avoid overseas delays. Q1 sales surged 25% to $302 million as new tax credit friendly orders kicked in. They swung from an EBITDA loss last year to $40.6 million profit, so it's translating into a 13% EBITDA margin that would have been impossible at smaller volumes. And debt relative to assets stayed flat after they extended their credit line instead of piling on new loans, keeping their financial flexibility intact. Analysts have their 12-month forecast at a negative 8%. When I began researching this, it had almost 30% upside, and the price jumped right before filming this. And now analysts are scrambling to increase their forecasts, which makes this a very interesting company because it's outperforming analyst projections and they can't quite figure it out. Sometimes misunderstood companies can do pretty well. Now, I've mentioned a few times how gold has blown up lately, where it's up over 27% year to date. That brings us to our sponsor for today, AXCP Ventures, who invests in gold mining, where their key asset is the Converse project, located in Nevada's Battle Mountain Trend, a top-tier gold jurisdiction producing 75% of the US's gold. And they're already sitting on 5.57 million ounces of measured and indicated gold. So if you do some simple math over 5 million ounces of indicated gold, along with their $10 million in cash holdings, it's worth way more than AXCP's market cap of $52 million, meaning that AXCP Venture is trading at around $5 to $6 per ounce based on their finding and their market cap. That is a massive discount to its peers who are trading at 700% more at around $40 to $60 an ounce. And another strong indicator is insiders have been buying stock in recent weeks at over $1.2 million in purchased stock in just the last quarter, of course, signaling strong confidence. If you want to learn more about AXCP Ventures, then please check out the link below. Our next company is Helios Towers, which operates over 14,000 cell sites across 9 African and Middle Eastern countries countries, leasing antenna space to multiple carriers on each tower. Their infrastructure sharing model delivers steady inflation-linked cash flow, an attractive twist on a fast-growing market. Revenue happened to tick up about 5% to $204 million as new tenancy agreements had increased, and adjusted EBITDA rose 9%, pushing their margins from a 53% to a 54.5%. Proof that efficiency gains and rental escalations are really working. Meanwhile, net leverage eased from 4.4x to 4x, thanks to a small debt paydown and stronger operating cash flow. And analysts have their 12-month forecast being up over 59%. Now on to the next company of PaySign, which specializes in prepaid card programs, from plasma donor rewards to pharma copay assistance cards. Then layers on patient affordability services. They've cornered a very niche of helping patients manage drug costs, a segment that exploded during recent healthcare reforms. Their Q1 revenue jumped 41% to over $18 million, fueled by a 260% surge in pharma patient programs. Then higher margin services lifted their adjusted EBITDA 193%, driving margins up to 27%, which happened to be 17% prior. And best of all, they're debt-free with $6.9 million cash on hand, so they're scaling without external financing. Analysts have their 12-month forecast at over 73% upside. Now let's discuss Talkspace, which lets you text or video chat with licensed therapists. Think of a therapy as a service, and it's shifted its focus from direct-to-consumer to employer and Medicare contracts. That pivot means steadier, larger-scale business-to-business deals instead of chasing those one-off subscriptions. Their total revenue would climb 15% to over $52 million, and it's powered by a 33% bump in payer B2B bookings. Their adjusted EBITDA more than doubled to $2 million, taking margin from 1.9% to 3.8%. And I get it, it's a small number, but it's a huge business that's fought losses for years. And their cash cushion of $60 million keeps them covered through seasonal ebbs. And analysts have their 12-month forecast at being up over 72%. Now on to the next company of Champion Iron Mines, with a high-grade 66% iron ore concentrate in Quebec. Their product commands a premium, with steelmakers chasing cleaner, higher efficiency inputs. And they're adding a direct reduction pellet plant to tap into that green steel trend. They hit their Q3 results with a revenue at $363 million, but they had 2 weeks of shipping disruptions, opening up growth for future quarters. EBITDA hit $180 million, up 20%, and margins expanded from 36% to 39% as they locked in better pricing. And with debt to assets around just 20%, they are well positioned for the next big leg of growth. Next, analysts have their 12-month forecast at over 42% for the next 12 months. Let's move on to the next company, which hits in the biotech area and is called Mankind, whose star is Afrezza, the inhalable insulin that sidesteps injections altogether. Plus, they run a contract manufacturing arm that earns them extra money. They happen to be small, but they're very profitable, thanks to licensing deals alongside that Afrezza royalty income. Overall, the revenue rose 18% to $78 million, as Afrezza prescription starts jumping 20% and the collaboration income climbed. Non-GAAP profit soared 80% to $21 million, lifting their margin to 28%, which is up from 23%. They happen to have no debt, and they have roughly $198 million cash, meaning that they can keep funding R&D and keep those partnerships going. And analysts have their 12-month forecast at being up over 128% for the next year. Next is Whitecap Resources, that drills and produces oil and gas in Western Canada, focusing on free cash flow fields that support a steady monthly dividend. They recently added U.S. acreage via acquisition to diversify geographically. It happens that higher commodity prices and production gains, up 6%, has pushed revenue to $942 million, which happens to be up 20% over last year. And their net income rocketed 172% to $163 million, lifting their net margin from 7% up to 17%. And their debt to assets improved just slightly after disciplined spending and cost controls. And analysts have their 12-month forecast at being up over 52%. Next is Skywater Technology, which is the only US-owned pure-play semiconductor foundry, crafting specialty chips for defense defense, aerospace, and industrial sensors. Their next big move is adding Infineon's Austin fab under a $1 billion supply deal, doubling their capacity for military-grade chips. Now, their Q1 revenue did dip 23% to $61 million, as some customer projects did wrap up a little bit early, and their EBITDA edged down 33% to only $4 million, which is trimming their margin from 9% down to 6.6%. And the capital-intensive fab builds keep their debt to assets nearly 60%. But they do have $18.8 million cash, which happens to ease their short-term needs. Analysts have their 12-month forecast at being up over 34% for the next year. And the next company is Palantir Pharma, which is a clinical stage biotech developing whatever that word is on the screen right now, a novel biologic in phase 3 for pulmonary, yeah, I'm going to put that word on the screen too, and other rare lung conditions. Their big catalyst? Well, it happens to be phase 3 readout expected in Q3 of this year, which could transform a pure R&D story into a commercial biotech winner. They're still pre-revenue with a Q1 net loss of $14 million, about a flat year-over-year scenario, and there's also no margin to speak of. But they do have a cash pile of over $78 million, and they don't have any debt, so that really helps fund them through pivotal times. And if trial results hit, their valuation could absolutely skyrocket. But honestly, that's the sort of story that we get for every biotech company. They raise a lot of funding, they burn through it as slow as possible, and then they try to get their product through all of the government testing, which makes biotech such a hard area to invest in. And analysts do have their 12-month forecast at over 544%, which is totally bonkers to me. I wish that I had more access to more of their information to really know if this is truly progressing to something big. That and the fact that they're hitting phase 3 trials in Q3 of this year, it does mean that next year, this one could be absolutely huge if the trial is successful. And of course, that is a huge if. So now here's a listing of all 10 companies with their 12-month forecasts from analysts. But for me, if I were to invest in only 3 of these, which I might, it would probably be Palantir Pharma because their trials are moving along. And my next choice is probably Paysign because they're managing their finances extremely well without much external funding. And the need for reducing medical costs, well, that's not going to go away anytime soon. And the third one that I would pick for myself is Talkspace. I love the fact that they changed their model to be more of a business-to-business model, and it really helps keep their revenue more consistent. Obviously, I have to ask, if you were to pick your top 3, let me know down in the comments. I'm very curious. As always, please keep the requests coming in, and I hope that you enjoyed the video. As always, thanks again for watching.